On 9th August 2024, Ola Electric became the first pure-play electric two-wheeler or E2W company to list on Indian stock exchanges. There were no listing gains as such, and the stock listed flat in terms of its issue price of 76 rupees. But it raced by about 20% on the listing day, closing at 91 rupees. The stock then more than compensated for its lackluster listing performance by going up to 146 rupees on 19th August, again of 92% from the issue price. But soon it reversed its course, dropping down to 67 on 21st November, thus falling below its issue price. Now it again bounced back to 99 on 3rd October, but has been falling since. Currently, it's trading at 53 rupees. Now the company has been entangled in problems related to customer complaints and its sales figures. Its net loss increased to 564 crores in the quarter ended December 2024, up from 376 crores a year ago. Now that's quite a bumpy journey for a company whose products seem to provide a smooth riding experience for its customers. Now, one of Ola Electric's main competitors, Ather Energy, is coming up with an IPO. Now, Ather comes fourth in terms of market share after Ola, TVS and Bajaj Auto as of 9 months ended December 2024. Now, given Ola Electric's woes, can Ather Energy prove to be a good substitute to play the EV or E2W theme? Or it will follow Ola Electric in its stock market journey? We will try to find out in this video. Hello and welcome to ET Money's YouTube channel. Ather Energy's IPO opens on 28th April and closes on 30th April. The company is raising around 2,981 crores. Now in this video, we will analyze the Ather's IPO for you so that you can decide whether you should invest in it. This video is divided into certain sections which are on your screen now. Now this video belongs to our playlist on IPO analysis. To watch our earlier analysis including Ola Electric, you can check it. The link is in the description. Okay, so let's start with checking the key details of the Ather's IPO. The key details of Ather's IPO are on your screen. The total issue size is 2,981 crores. This makes it the third largest IPO of 2025 after Hexaware and Dr. Agarwal's Healthcare. Now of the 2981 crore, 2626 crore is a fresh issue and the remaining 355 crore is an offer for sale or OFS. In the fresh issue, the company issues new shares and in an OFS, the existing shareholders sell part of their stake. Now there is an employee quota in the IPO as well. Up to 1 lakh shares are reserved for employees and are being offered at a discount of 30 rupees per share. The IPO opens on 20th April and closes on 30th April, as we saw at the start of this video. The lot size is 46 shares, so a retail investor can apply for these many shares and can add more shares in this lot size. The price band is 304 to 321. At the upper price band, the minimum investment required for retail investors is 14,766. Now to increase the chances of IPO allotment, it's advisable that one should apply at the upper band or the cutoff price. Now the company's existing share count is 29 crore shares. Post IPO, it will increase to 37 crore shares. Post IPO, the promoter's stake in the company will come down from the current 52.7% to about 42%. Now as far as the company's pre-offer shareholding is concerned, Hero MotoCorp is the biggest shareholder with a 38% stake. It is also among the company's promoters. The other promoters are Tarun Sanjay Mehta and Swapnil Babalal Jain. They each have 6.81% shares. Among the company's other prominent shareholders are Caladium Investment and Internet Fund 3 PTE. Caladium is an affiliate of the Singapore-based Sovereign Wealth Fund GIC, and the Internet Fund 3 is managed by Tiger Global, an American investment firm. Now Tarun Sanjay Mehta, Swapnil Babalal Jain, Caladium and Internet Fund 3, among others, are selling shareholders too and are taking part in the share sale through the OFS route. But Hero MotoCorp isn't selling any shares. Okay, let's now take a look at the company's business. Founded in 2013, Ather Energy is a pure-play EV company that sells electric two-wheelers and the associated products, including software, charging infrastructure, and smart accessories. The company manufactures its battery packs in-house. Its portable chargers and motors are designed and manufactured by suppliers. Now, it designs other key E2W components such as motor controllers, transmissions, vehicle control units, dashboards, etc. and their manufacturing is outsourced to external suppliers. Now, Ather's current portfolio consists of two product lines: the Ather 450 line, which caters to customers seeking performance scooters, and the Ather Rista line, which is targeted at consumers seeking convenience scooters for their family. Now, the company's manufacturing facilities are located near Hosur in Tamil Nadu. At the Hosur factory, the company has a total installed capacity of about 4.2 lakh units of E2Ws and about 3.79 lakh units of battery packs as of December 2024. Ather is also building its factory 3.0 in Maharashtra. Now, it will take Ather's installed capacity to 14.2 lakh units for E2Ws. As of December 2024, the company has 265 experience centers and 233 service centers in India. Apart from these, it also has presence in Nepal and Sri Lanka. Now, as per Ather, its business model is founded on four key pillars: vertically integrated approach to design, software-defined ecosystem, premium positioning, and capital-efficient approach to business operations across the value chain. The company's in-house developed software called Ather Stack powers all its products. Its EV charging solutions comprise the Ather Grid and portable chargers for home charging. Ather Grid is a public charging network of about 2,600 fast chargers and 600 neighborhood chargers spread across 314 cities in India, Nepal, and Sri Lanka. Its portable chargers are bundled and sold with its E2Ws. Now, as far as Ather's industry outlook is concerned, within two-wheelers, EVs are a futuristic segment. With the growth of the ICE or internal combustion engine two-wheelers is expected to be flat between FY24 and FY31, E2Ws are expected to grow by 40 to 42% per annum, thus becoming 35% of the total two-wheeler units sold. Now, a robust charging infrastructure is indispensable for the growth of EVs and E2Ws. So, even the two-wheeler public charging infra is expected to grow by 30 to 38% per annum between FY24 and FY31. So, overall, there appears to be strong demand visibility for Ather's products. Next, let's look at the company's financials and valuations. Let's take a look at some of the key financials of Ather Energy. Now, over the last two financial years, Ather's revenues have jumped from about 414 crores to about 1800 crores. That's a growth of 108% per annum. However, on a year-on-year basis, the revenue has dipped by 0.7%. The company has been loss-making, with losses ballooning from 344 crores in FY22 to about 1000 crores in FY24. The company's cash flows from operations have been negative and also grown from minus 199 crores to negative 704 crores. The debt to equity ratio has come down from 1.62 to 0.88, and that's good. Now, due to the losses, the operating margins and the ROE are negative too. However, an improving operating margin suggests better performance by the company's core business. Now, as far as the company's 9-month results as of December 2024 are concerned, the revenue has grown by 29%, net loss has shrunk from about 760 crores to 578 crores, and the operating margin has improved further. Now, in spite of these improvements, overall, Ather appears to be in bad shape. Okay, let's also compare how it stacks against its main listed rival, Ola Electric. Now, as of 9 months ended December 2024, Ola Electric sold 3 times as many vehicles as Ather did. Indeed, in terms of market share too, Ather's market share is just a third that of Ola Electric. Ather's market cap is about half that of Ola and its revenues is a third. Both Ather and Ola Electric are loss-making. Now, in terms of revenue growth, both have a triple-digit number because the industry is in a nascent stage. Ola is more indebted than Ather in terms of their debt to equity ratio. Finally, in terms of the valuations, as measured by the price to sales ratio, Ola is cheaper than Ather. Overall, not only is Ola ahead of Ather in terms of size, it's relatively cheaper too. Okay, let's now look at some important IPO related metrics. When it comes to IPO investing, it's not sufficient to check the business, financials and valuations. One should also take a look at the few crucial IPO related metrics. We talked about this in an earlier video on how to analyze IPOs. Let's take a look at some key IPO related metrics now. The first is a split between the fresh issue and offer for sale or OFS. An IPO issue has two components, fresh issue and the offer for sale or OFS. In a fresh issue, the amount raised goes to the company and hence is deployed in the business. In an OFS, the amount doesn't go to the company but to the selling shareholders. So from an investor's point of view, the larger the proportion of the fresh issue, the better. In Ather's IPO, the majority of the issue is a fresh issue. There is an OFS component of about 355 crores too, but that should not be a problem. The next criteria is the objects of the offer. The reason for which a company is raising money matters too. In the IPO lingo, it's called objects of the offer. Broadly, if a company is raising money to resolve a crisis or a problem such as high debt, that's usually a red flag. If the company is raising money for growth, that's good. Now, Ather is raising money to support capex at its Maharashtra factory, repayment of certain borrowings, investment in R&D, and for marketing initiatives. The component of borrowing repayment is just 40 crores. The rest of the objects are related to the company's growth, so they shouldn't be a problem. The next criteria is outstanding litigation. The outstanding litigation against a company tells us about the quality of corporate governance and also the financial liabilities a company may have to face. Ather has pending litigations worth 116 crores against it. Against the company's promoters, the litigation amount stands at staggering 10,144 crores. Now, such a high amount can be a source of problems for the company in the future. The next criteria is contingent liabilities. A contingent liability is a possible obligation that may or may not occur depending on a future event. So low to nil contingent liabilities are desirable. The company has contingent liabilities of 61 crore related to custom duties, GST, income tax, etc. This amount is 56% of the company's net worth. The company is also contesting a demand of about 60 crore from the GST department. However, it doesn't see the demand materializing. The next criteria is share acquisition at a price lower than the IPO price. One way to know if an IPO price is reasonable or not is to look at the share issued by the company in the last 1 year. Now, in the last 1 year, there have been multiple equity issuances at prices much lower than the IPO price. The promoters Tarun Sanjay Mehta and Swapnil Babanlal Jain acquired shares at 21 rupees. They are also selling their shares in the issue via the OFS route. Other shareholders were issued shares for 8 to 204 rupees. The IPO price band of 304 to 321 is much higher than these issue prices. This suggests that retail investors are being sold shares at a steep premium. The last criteria is risk factors. The company has mentioned 104 risk factors in its RHP. However, many of them are like disclaimers and standard statements. Let's take a look at some of the most prominent ones. First, in the past, the company has received customer complaints related to its products. These complaints relate to product failure, durability, battery, etc. For the 9 months ended December 2024, the number of complaints received stand at 2,383. This is similar to the problem Ola Electric is facing, so it could be a big red flag. Second, the company admits that the lithium-ion cells used in its electric two-wheelers are prone to catching fire or venting out smoke even if properly manufactured, managed or controlled. Third, the company relies on China for some of its components. As of 9 months ended December 2024, China contributed 25% of the total cost of materials consumed. So, the company is also vulnerable to geopolitical headwinds on this account. Fourth, the company's market share has also dipped over the 9-month period ended December 2024 year-on-year from 11.3% to 10.7%. Now, this may suggest cutthroat competition or higher consumer preference for competitors' products. Fifth, the company's sales are concentrated in South India and hence can be impacted due to business or political disruptions in that part of the country. As of 9 months ended December 2024, the company derived 60% of its volumes from South India. Now you can read the full list of risk factors in the company's RHP. So these were the key IPO metrics that one needs to check. Okay, let's now summarize the analysis in this video so that you can decide whether or not you should apply in Ather Energy's IPO. Ather Energy belongs to the futuristic industry of electric two-wheelers, which is also experiencing high growth. This industry is not faddish, but is indeed the need of the hour. Ather is the early entrant to India's E2W space and has rapidly built capacity. It's expanding as well, as seen by its new manufacturing facility in Maharashtra. The company's revenue growth is robust and reflects the underlying tailwinds. The presence of Hero MotoCorp as a promoter suggests that the company has a solid backing too, both in financial and business terms. But the company seems to be in a bad financial position. Its losses are rising and the cash is rushing out of the business. This needs to be plugged for financial sustainability. Now, in terms of valuations, the IPO appears to be expensive. Ather's larger peer Ola Electric is currently trading at a lower valuation. Now, given that the company has issued shares in the last 1 year at much lower price, it appears that retail investors aren't getting a good deal. Another important thing to note is that according to some reports, the company has cut its valuation twice before the IPO. It first targeted a valuation range between 17,000 to 20,000 crore and then around 14,000 crores. The IPO has settled at a valuation of about 12,000 crores. The amounts involved in litigation against the company are substantial and can be a drag on its performance. Contingent liabilities are on a higher side too. Finally, some of the risk factors, especially customer complaints, battery catching fire, over-reliance on China, and a failure to gain market share are quite serious. And with this, I have told you what you needed to know about Ather Energy's IPO. Now, it's your turn to tell us and your fellow viewers whether you will apply in its IPO, along with a rationale for your answer. So do let us know in the comment section. And if you liked the video, don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.